please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
What about the BTST calls, Ashwani, then?
See, on BTST, Asian Paints is a buy with a stop of 1160, target of 1210. Oro Pharma is a buy with a stop of 635, target of 660. And PVR is a buy with a stop of 1355, target of 1410.
Mitesh, your trades as well?
Yeah, so I also have a buy on a pharma name. In fact, both of them are pharma names. Glenmark, I think, is re-entering some kind of an uptrend, so buy with a stop at 566. Look for targets of 620. Now, BTST and Dupin slightly come off, so if it starts getting past 817 zones again, take a BTST trade with a stop at about 809 and look for 834 kind of target.
All right, gentlemen, thank you for those calls. Anand, before we let you go, just a very quick question. A word on IndusInd Bank, the divergence, etc., all those issues. Today, the stock is quite excited. Your views?
Well, you know, most of the banks, the divergence is an issue, and I think that needs to be fixed, because I can't imagine that, you know, RBI has a different way of looking at things and the banks can't seem to follow that. But that said, you know, it's one of the better performing banks. Performance is reasonably good. So from a portfolio perspective, I think, you know, you will perhaps need to have that in the portfolio, given the fact that the public sector banks are still limping. But if you are looking for outperformance and you take a bet that the industry will do well this year, I think SBI kind of stock may actually give you a better upside over the next 12 months than many of the private sector banks.
Point taken, Anand. Thanks a lot. NBFCs are doing well. We spoke about them. Of course, Chola's numbers look good. Shriram Transport, just see the intraday chart of that one. And gas stocks are making a bit of a comeback. Both IGL and MGL, not by much, but for whatever it's worth, the stocks are now trading at the high point of the day. Both IGL and Mahanagar Gas. That's of course Shriram Transport. Just look at that move on that stock. Just took off. And IGL is at the high point and MGL as well is at the high point. But mid-cap mania time. Nigel, over to you.
Well, all of last week, there was one stock that was on everyone's radar. The stock that we're talking about is ITC last week.
ITC is a stock which recently we started buying in PMS.
ITC's stock seen a good consolidation here.
60% of today's gains are courtesy ITC.
ITC is a buy.
ITC has crossed its 200-day moving average.
In that contribution played, it was ITC versus the banks.
ITC was the player which was doing still well.
Well, obviously, the stock we're not talking about, it's not a mid-cap, you know, if we're talking about ITC. But the stock that we're talking about is ITH. That's International Travel House. Why are we talking about this particular company? Well, it's a small 160 crore company, market cap company. But the reason why we're talking about ITC and this company is because ITC is the promoter. It has nearly around 61% stake in this listed company. That's International Travel House. Now, if you're looking at this company, you'll say, what does it do? Well, it's into travel. So it's playing that tourism theme really. And in fact, it's into various business development. They're into car rentals, foreign exchange, as well as MIC. That's meetings, incentives, conferences, as well as exhibitions. But you'll say, what else does the company do? Well, they have a couple of global tie-ups as well, and they are approved by IATA as well as Department of Tourism. That's by the Government of India. And internationally, they have a couple of these global tie-ups as well. Notably, in their presentation and in their annual report of last year, they mentioned Global Star Travel Management. But moving on then, and if you just take a look at this company, and you'll be looking at it very, very closely, you'll see who are their clients. Well, a whole host of clients were mentioned in the annual report. I picked up a couple of them, and this is what is mentioned in 2017 annual report. But we're looking at various numbers and various financials for the company then. So if you pull up the next slide, then you'll say the market capitalization is around 160 crores. They have a decent cash balance, close to around 40 crores. It's into various mutual funds and liquid investments. So close to around 20-25% of the market cap is protected by cash in its books. If you look at the net worth of the company, well, it's almost as much as the market capitalization. So trading at around 1 time price to book. Moving on, then you'll ask, what about the dividend? They've been paying dividend consistently of around 4.25 rupees for the last many quarters, though the EPS growth hasn't really caught up. In fact, the EPS growth has been declining from roughly around, at one point of time, they used to do a net profit of around 15 to around 20 crores. Now, that number has come down sharply lower, but the dividend payout has, is at around 4.25 rupees. That's telling you that the dividend payout ratio has gone up in spite of the financials not looking very, very good. you'll pull up, the last quarter's results, and that's why, in fact, the company did come on my radar. Fourth quarter looked good. It looked better on a small base, but the last few years, they've not done much. Revenues, 180 crores to around 210 crores over the last 4 to around 5 years. The margins, at one point of time, they used to do margins in excess of around 15 to around 20%. Now, that's come down lower. You just pull up the last few years of the revenue chart, 180 to around 210 crores is what they were doing. In the past year, the margins had come down drastically. So that's the revenue number we're talking about. The margin number as well should come up for you on the screen. That's seen a bit of a decline. And obviously, poor operational performance will tell you that the net profit as well hasn't grown much. So the net profit number as well should come up for you on the screen. Last quarter, only around 7 crores. So 160 crore market capitalization company doing only 7 crores of net profit. Not very, very good for all the talk and hype and being in a sector that's really in tourism. Well, what are the key negatives? We have such a strong promoter. You're not given any growth in the last few years. The receivable days, you're doing sales of around 200 crores. Receivables of around 110 crores or thereabouts. So receivable days will be nearly around 6 months. And finally, the ROE, ROCE, and they have cash in their books. So I've even calculated the ROIC, all of them in single digits. So good parentage, you have good dividend payout, cash in the books. But interesting to see, can the business grow from here? Can we see better margins going ahead?
Okay, Nigel, thanks a lot for that. Standard disclaimer, not a stock recommendation, just some interesting research Nigel has done. TCS is now actually almost in the red, almost a culmination of at least one move, perhaps from 2,800 all the way up to 30. Okay, it's in the red now. 33.99 is what we have. 33.98. Of course, still can't take away from it that it hit $100 billion market cap today, but going to close below that. Mayuresh Joshi of Angel is also with us. Mayuresh, good afternoon. Quick thoughts on Cholamandalam first, where we had the numbers just about half an hour back.
Afternoon, Anuj. So I think this is one stock that I've liked for a period of time, and the numbers have been astounding in my opinion. Very strong disbursement growth. If you look at the AUM growth, equally strong, and at the same time, with such a stupendous growth, the asset quality pressures on a quarter-on-quarter basis, both on the GNP and the net NPA front, have actually come down. On the other hand, again, I think the expectations in terms of the AUM growth going ahead, there is strong belief that a 15-18% AUM growth can be maintained, to say the least, along with stable asset quality ratios, which should provide stability both in terms of the reported NIMs and the return ratios that it posts. Again, on a price to adjusted book, even if I take an adjusted book of around 425 rupees for FY20, it does trade around 4 odd times on that valuation parameter. But again, looking at the numbers that this company has been posting, specifically the growth seen in vehicular finance, and again, I think the expectations that we largely have, I think investors who are holding on to the stock from low level should continue holding.
IT clearly seems to be a case of people getting vertigo, and then there are stocks like Hindalco. Hindalco is at the lows of the day as well after its breathtaking rally of last week. There's profit taking that continues even in some quarters like that one. Well, let's straight away get across to Nimesh Shah, who will tell us how Monday has played out in dealing rooms today. Nimesh, what are the conversations you picked up?
Hi, Surabhi. So, maybe some bit of profit booking in IT names, but essentially what I'm getting is, there is this clear under ownership of IT, which is getting reversed in the last few days, and today being no different. So there is this delivery-based buying happening in the large cap IT names across dealing rooms. However, in terms of mid cap IT, there is some bit of concerns now, given the sharp rally in those names and the fact that many of these are trading at expensive valuation. So a bit of a different view vis-a-vis the large cap names and mid cap IT names at least at this point in time. In terms of flows, my sense is that both FIs and DIs will probably net buys in today's trade, and there's a lot of action in the mid cap space from the domestic investors, where the HNI seems to be net sellers. So the supply of HNIs and super HNIs in the mid cap is getting easily absorbed by the domestic funds in the last few days. A word on the pharma names, a first tick of uptick in that space as well, and the feedback there is, given the way the under ownership in IT has hurt a lot of fund managers, now they're worried about their under ownership in pharma names as well. So maybe in the next few days you'll see some bit of reverse or adjustment to the under ownership of pharma names, and that can see a bit of a rally in the pharma names as well. But clearly from an institutional point of view, there is this delivery-based buying in IT names even in today's trade, and now people are watching out to cut out their underweights in the pharma stocks.
Oh yes, pharma stocks are now looking good, 1.5% higher on the index itself. Nimesh, thanks a lot for that. 4 minutes left for markets to close. Ashwani, what would be the key takeaway for you? Because the mid caps did well, and the Nifty not quite closing at the highs of the day, but still well off the lows of the morning, of course.
Well, the change is that the Nifty is closing at a bit of a premium, so that helps. Bank Nifty also some bit of short covering at lower levels, but it's clear, the tailwind is with IT. Banks will be basically drag along till, something changes on the, inflation landscape. So that way, again, Nifty failed because of Bank Nifty. So maybe till things don't turn for the banks, we may be condemned to this range, because Reliance has to participate. I think it started doing that, but midway kind of gave up. So either it is IT and banks or IT and Reliance, which looks like the better possibility if we need to have a strong breakout.
Okay. We've just got about 2-3 minutes left. So very quickly, Mayuresh, call on RIL. Obviously, it's also getting into its earnings this week.
I think strong numbers, Surabhi, should come through specifically in its core segments, but the interesting commentary would also be focused around what happens with the Jio capex and the plans thereof. So again, expecting a reasonable set of numbers to come in both from the petchem as well as the refining business. Though I think the kind of competition intensity you've seen, the data ARPU specifically for Jio, might get curtailed a tad bit. But generally, I think the numbers should be quite reasonable in my opinion.
Okay, well, we have just 2 minutes to close out the day. So maybe we can start a recap. Anuj, how will you classify this? Because we couldn't get that, the perfect bull close above 10,600. So then where does this leave us?
Yeah, so 10,600 once again is now, now we've got two well-defined boundaries, Surabhi. Somewhere around 10,500 on the way down, 10,620 on the way up. For now, and I think you trade the break of this boundary now, and in between you trade in that boundary. But then as Ashwani was saying, and this cool off in IT stock that you're seeing is essentially just, some smart money taking some money off. It's been such a huge rally, and over the next 2 or 3 days, or over next 1 week, perhaps you would see that perhaps IT sort of sees some profit taking, but the move has established that that's the leader now. It's been a leader now for 6 months, more than that, and I think that part is intact. But for today, of course, there was some profit taking from higher levels. What was also interesting was that NBFCs did well today. Of course, Surabhi will talk about all the stocks led by that big move in Cholamandalam. But in terms of Nifty stocks, of course, since we're ending in the green, let's start with the stocks that gained ground today. IndusInd Bank, and I mean, it's just been remarkable the way this stock has shown this same trend quarter after quarter. There is some profit taking after the numbers, but then the stock makes a big move. In fact, it's up about what 5% now for this month, considering today's big move, and up about 3.6% today. So that was the big mover. Mahindra & Mahindra was up at 3%. Then, of course, oil marketing companies, BP, HP, IOC, they have rallied, and this really is getting interesting now, the way some of these stocks are rallying. Pharma stocks ended at high point today. Just keep an eye on some of them. Sun Pharma, Cipla, Dr. Reddy's, Lupin, most of them closing closer to the high point of the day. Then, of course, on the way down, Hindalco was down 2.5%. ICICI Bank has been a problem for the market now. In fact, from the recent highs, it's been a swift slide for ICICI Bank, 279 now on that one. Tata Motors was a bit soft. Larsen & Toubro as well, a bit off the mark, and and Indiabulls Housing Finance did see some profit taking, so that one down about 2.5%.
Okay, on the mid-cap side of the market, the index has actually done much better than what we've seen on the large-cap benchmarks, about 100 points up. Let's drill down to stocks then. I'm going to actually start off with IT just to round up some of the names. So you had a lot of profit taking come through, that was evident. But even then, some of the stocks, L&T Infotech 9%, L&T Tech up 5-6%. You've had some additional gains coming in on Memphis 5% on the higher side. So some of these counters continue to buzz. KPIT Tech, Persistent, a lot of these stocks were off the highs of the day, but nonetheless, Cyient, they've managed about a 1-3% sort of an up move, many of them sitting at 52-week highs. If I move beyond IT and then talk about the other movers and shakers, lots of buying on the NBFC side. The stock of the afternoon perhaps has to be Cholamandalam. We're talking about a 9% up move, and it took its peer Shriram Transport Finance up with it as well. So that's Chola for you after the blowout numbers we've seen in Q4. Let's pull up Shriram Transport. So that had a bit of a rub-off effect going as well. Perhaps this rural theme is still active in the market. So it's M&M on the large cap side. In the mid cap side, you have stocks like VST Tillers doing well. M&M Financials has done well. Ujjivan So a lot of the SME rural-facing themes kind of played out through the NBFC route today as well. Bajaj Electrics has had another blowout session since this company got those latest tranche of big orders. The buying continues 6.5% up over there. Good day for Oberoi Realty, about 11% up. By the way, NIIT Tech, by virtue of its holding, NIIT, by virtue of its holding in NIIT Tech, continues to be a strong counter. So that's the tech stock. If you look at the parent, there's an 8% up move that you've got there as well. Astra Micro saw some buying, 9% up towards the end. Good day for Lovable. Decent day for something like a Max Financial, about a 4% up move coming in over there. Minda Corporation, Coffee Day. These are some of the other buzzers. On the losing side of the screen, some of the ADAG group stocks were quite noticeable, whether it's Reliance Communications or our Naval. These stocks lost some ground today. We'll just get the losers list up for you as well. Reliance Naval and Reliance Communications, we'll just pull them up. Yeah. The other ones are Radico Khaitan, a bit of a cool-off coming through. GNFC, after the big fertilizer rally, GSFC and GNFC lost some ground today. Tires were interestingly mixed. Let's see the close on Apollo, because Apollo had a very big sort of spike up in the last few minutes, but JK is ending negative, so mixed bag for the tire arena. So that's how the mid-cap trend has played out.
Oh yes, let's take some final thoughts then from our experts. Mitesh, same question that I asked Ashwani as well. Your thoughts on the day, and are you buying this market on dips, or are you selling the rallies now?
I think, Kanuj, on the index, we have been taking profits, and today afternoon also I said that I'll buy only once we get past 10,630, possibly even today's high 10,638. That becomes the next pivot. So I think unless until that has been crossed, I don't think I'm very keen to buy into the indices right now. But on the stock specific side, we have been trading with more of long buys. The only thing which has happened is some kind of switch and sector rotation. I think pharma has come back strongly today. The Nifty Pharma Index has had some kind of a breakout. So I think that's where the trading positions have come in. And on the bank side, I still remain negative. And I think it's the bank Nifty which continues to put pressure on the Nifty, preventing it to get past 10,630 immediately. So I think another 2-3 days of consolidation, and then we might have more strength to get past these levels. Till then, I think a buy on dips is a good strategy on the indices. 10,500 or thereabouts would be excellent levels to initiate longs on Nifty.
Okay, Ashwani, before we let you go, just one final chart check. Oberoi Real Estate, big move in last hour on that stock.
Today, all realty stocks, including Godrej Properties, also did well. But Oberoi Realty is now getting past, some sort of consolidation at 560. So chances are you are looking at 700 on Oberoi Realty, and all realty stocks, particularly Soba and Godrej, etc., Prestige, they are likely to move higher in the days to come.
Okay, finally, Mayuresh, your favorite pharma stock for now?
So Ipca Labs would be something that I like. The domestic formulation business has held up pretty well for the company, and the cash flow yield from the domestic formulation business is holding up their overall valuations on an SOTP basis. As far as their export business is concerned, the three concerns on the FDA observations on 3 of their plants is obviously playing truant. But a large element in terms of the remedial costs that they have incurred and any breakthroughs that they probably get over the next few quarters is going to be a big win-win. The third angle obviously is going to be these IMF contracts, the anti-malarial contracts, and that obviously will abet their overall earnings portfolio as well. So again, I think the cash cow is the domestic formulation business, which is growing at a very healthy pace. And even from a valuation perspective at these levels, I think it looks pretty attractive. So any decline onto the stock, in my opinion, becomes a very good buying opportunity for long-term investors.
Pebbles Housing Finance, of course, delivered numbers that were more or less in line with expectations. There was robust growth as far as the assets under management figure is concerned. That was a 7-quarter high. Spreads, however, came in at a 7-quarter low, and that's something that weighed on the market's mind. We caught up with Gagan Banga, VC and MD of the housing finance company, to get his sense on the growth outlook.
The last 2 years, we've been managing to grow the book between 30 and 35%. And that's largely because affordability in the housing space from a consumer point of view has been steadily improving. Prices of homes have been flattish. Interest rates have been down, and ever since the subsidy program kicked in, it's been meaningfully cheaper for someone to buy a house as against live in a house. After the CLSS scheme, the PMAY scheme, it is very, very attractive for the salaried guy to be taking a home loan, and we're trying to do a reach out program to them rather than just wait at either the construction site or in our offices.
Moving on, Phoenix Mills and the Canada Pension Plan Investment Board have joined hands. There's a joint venture that they have done, investing about 650 crore rupees in land for retail development in Bengaluru. We caught up with Shishir Srivastava, ED of Phoenix Mills, to know more about this deal.
With the proposed development at Hebbal, which will cater to north and western Bangalore, I think we will have captured the entire market of Bangalore. Currently, we operate a little over 6 million square feet, and with the acquisitions that we have under our belt under the platform with CPPIB, we are developing rental assets of close to about 5 million square feet under that platform. We completed an acquisition in Pune last year, and now with this acquisition at Hebbal, and also we have some balanced development potential at the existing operating assets under the platform which is in Bangalore East. Between these three, the total development potential of retail is about 2.35. So upon completion of this development, we will be close to about 8.5 million square feet of retail assets under our belt.
Moving on, India's current account deficit is nearing the 3% mark with rising crude oil prices and declining FDI flows. This, of course, is becoming a cause of concern for the market as well. Lata Venkatesh spoke with a whole host of experts like Sajid Chinoy of JP Morgan, Ashma Goyal, member of the PMEAC, as well as Neeraj Gambhir of Nomura, to get their sense on the macros and the way forward for the current account deficit.
When oil prices move up so rapidly as they have in the last 6 months, this is an adverse terms of trade shock for India as a large oil importer, and more fundamentally, this makes the growth inflation trade-off much worse. So that's a more fundamental problem. On the external front, we've had a view for a very long time. 6 months ago, we said that in a world where growth was very strong, India's exports underperformed. And last year, despite growth slowing, imports were very strong. So despite GDP growth slowing in 2017-18, the current account deficit is on course to tripling from $15 billion last year to almost $50 billion in 17-18. Now, if on that base you overlay a crude estimate of about $70 a barrel for 18-19, the current account deficit is about $75 billion or about 2.7% of GDP. So not nearly at 3, but above the 2.5% considered sustainable.
We should not extrapolate from the current situation because markets, there are possibilities of correction. One reason for slow export growth has been the GST, and the GST Council has shown a very fast response. They need to sort of go into this in a very granular fashion and see what are the constraints specifically and what can they do about it quickly. And for oil, most analysts still think that the long run oil price is between 60 and 70, because if it will not sustain for very long above 70 because of the supply response or loss of market share and longer term substitution for non-oil sources of energy. There are a number of sort of self-correcting features in all markets. Remittances into India rise, which helps the current account adjust somewhat. So as long as we take action, I think there is no need to really panic. And in fact, panic is what creates a tipping point, not the market volatility.
At the margin, this kind of underperformance by rupee should actually help exports, even though exports per se may not be that currency sensitive. But at the margin, the 6% underperformance versus some of the major currencies is something which should help. And we should see some benefit of that coming into our current account numbers going forward. Our estimate is that every $10 of increase in crude oil prices adds to about 40 basis points of current account deficit. So we were averaging at 2% of current account deficit at an average oil price of about $67. So from 67 we go to 77 average, we should see about 2.5% current account. Now 2% is a safe zone, 2.5% is somewhat concerning, but still not a panicky zone. It's somewhat concerning. So I think we can absorb that additional $10, but need to be vigilant.
Another start to the beginning to the week rather, and we have a very, very volatile market with the crude oil prices still holding around those 3.5-year highs, and we have seen further gains come in for many of those metals, especially aluminium, which continues to outperform the sector. Mark Keenan now joins us, who's Global Commodities Strategy and Head of Research Asia Pacific at Societe Generale. He joins us on the show to talk more about all of those commodities. Mark, hi, pleasure to have you on the show. Let's start with gold prices first. And where do you see them headed? Where do you see the prices actually quarter-over-quarter? And how do you see this year ending when it comes to that one?
I see the year ending at about $1,275 an ounce. So a little bit of downside. We're around $1,350 at the moment.
Mark, but there have been reports on how the gold prices perhaps can start off to gain from here. There have been reports suggesting that $1,450 perhaps is on the anvil.
We do not agree with that. No, no. We see the demand for gold is weak. Demand for it as a safe haven is disappointing, and the general outlook is that gold is going to face headwinds as we move into a higher rate environment, and gold suffers in that situation, and so we expect gold prices to weaken, or indeed any strength that we see in the short term to sell it.
All right, so bearish on the gold prices, but what is your sense on the crude oil prices, Mark? Because they seem to be holding on the higher side of the range. There is firm demand estimates, there is geopolitical concerns, there is this Iran sanction tensions, which the markets also are tackling right now.
Look, I think the crude oil market is particularly fascinating right now, and particularly interesting is the May the 12th date that we have on the horizon, where Trump has to think about the sanctions, the rolling over of the sanctions agreements with Iran. We think there's a 70% probability that sanctions are reimposed back on Iran. The change in the senior levels of administration in the U.S. government, with Rex Tillerson now leaving, being replaced by Pompeo and so on, NSA advisor being replaced with Bolton now. They are foreign policy hawks, and they are very likely going to side with Trump in having these sanctions put back on. So what does that mean? We think the price of oil goes up $10 from where we are now. Arguably $5 is already priced in. There is quite some consensus building in the market that this does happen. But still, if we take Brent at the moment at $72 now, that takes us up to around $78, $79, and volatility is no doubt going to increase significantly. So that's the immediate thing that we're focusing on at the moment.
All right, so crude oil prices have a possibility of moving higher from here, especially on the back of geopolitics. But Mark, what about the metal prices? And they have seen a huge run up with the sanctions. How would you look at the aluminum price? Is up 25% in this month, but the inventories on the LME warehouses also have been increasing. Would you say there's a bit of a confusion when you look at the kind of fundamentals we are dealing with?
Which is causing some confusion for many of the speculators. So people that have been tracking inventories, that have taken long positions in aluminium, are citing that, and there has been quite some movement, especially into the European LME warehouses. So it looks like the rally, the very steep rally, it's been about $400 a ton in aluminium since the beginning of April on the back of the imposition of these sanctions, is running out of steam. I think that people that have made money out of it are now looking to take profit. We see, the aluminium price, about $200–300 in excess of where we have our fundamental target. We were already bullish aluminium this year for the supply cutback reasons. But aluminium, and to a certain extent nickel, that's followed suit a little bit on the back of these Russian sanctions due to the overlap between the businesses of certain companies, of Rusal and Norilsk, for example. So we see it at the top of the recent rally. The other metals, and it's to get some idea of where we see the complex going. It's always good to focus on metals like copper, where we are bullish copper. Copper has had a little bit of weakness creeping into it as a function of the increased trade war rhetoric that we've had over the last few weeks ago. That seems to be dissipating now, but we see upside in copper from here to about 7,100, 7,200 by year end. We see zinc approximately fair valued. But the other two that have run away on the back of these sanctions are overdone, frankly, and we advise not getting into them at the moment. And if you've taken long positions in it, then look to take profit on that.
That's a near term that you're talking about, Mark, that we might see some profit taking, which you perhaps are seeing in some of those metals. But what is your long-term sense? Because we still are under-invested into this sector. There is a deficit. And of course, the whole EV story, how do you see that impacting metals?
Our longer-term view for metals is constructive. You know, the backdrop is very simply a function of the fact that over the last, many years, 3 to 5 years, we've had a period of underinvestment in new supply because prices were low, and that is now translating into future supply crunches, especially in the context of global growth being as diversified and as synchronous and as robust as it's playing out to be. So we're bullish the complex as a whole. Specifically copper. I mean, copper is one of the metals that is going to benefit, however, to address your question on electric vehicles, however the EV market plays out in terms of battery technologies and so on, because of course copper is used in the charging framework, in the facilities that are needed to provide the extra infrastructure and wiring to have an electric vehicle market. Indeed, also electric vehicles at the moment, a car uses about 60 kilos of copper for a normal conventional car. An electric vehicle uses 3 times that amount because of the extra wiring. So copper plays out well.
All right, so strong demand expected in case of metals, especially copper. Thank you so much, Mark, for joining us and giving us a sense on all of those commodities where he clearly is bearish gold but bullish in case of crude and copper going forward for 2018. Kishore Narne of Motilal Oswal joins us. Kishore, hi. What is your sense? And I want to start by asking about metals, especially aluminum, nickel, copper. Where do you see more reasoning coming in?
Good afternoon, Manisha. I think pretty much I agree with him on the EV front. But again, on the short term, I think the Rusal issue is playing on the forefront of both nickel as well as aluminum, and the momentum is expected to continue for a while from here, despite the long-term fundamentals being bullish. Maybe in the short term we have had a very sharp rally, so risk reward at this point is not very favorable, though I'm not saying that you go and sell nickel and aluminum in the market right now. We still remain bullish on both of these metals, but with a very high cautious note assigned to that.
Kishore, how are you looking at the crude oil prices? Because there are more fundamentals bullish than bearish. Of course, the US output is one thing that to keep in mind. Given in the backlight of all that, how are you trading it right now?
I think we are in the last leg of the strength as far as I'm concerned in the medium term. Maybe if you're looking at a couple of months perspective, not beyond that, because the visibility beyond that is not really that clear. The one major factor is that OECD inventories came down and now they're marginally higher than what they used to be in the 5-year average. Is one fundamental factor which supports crude prices, along with the sentimental factors of OPEC and Russia trying to push it up. But at the same time, the rig count has started to go up. Now we are at the highest level since last March. Again, I think anything beyond 70, 72 in Brent or close to 70 in WTI, it makes extremely attractive for the shale oil players. So I think slowly and gradually shale oil producers will push more oil into the market. So sustaining above 70 for WTI will be really difficult. But again, I'm saying that in short term there is a little bit more steam in the rally. So at this point of time, one can still go and buy for short term. Maybe for today we are looking at buying at 4510, 4460 as a stop loss and targets close to 4580.
And final call on the gold prices. What is your sense? Is it going to 1250 or 1450 by the end of this year? Because as many as the people you talk to, there is a very divergent outlook.
I think I'm in the bullish camp. 1480 or plus. No, I think if you're looking at 24-month perspective, probably even you're looking at close to 1600s also. See, predominantly what I see is that the result of trade war or whatever the protective measures are, the reverse of globalization will lead to inflationary spikes, because you try to produce goods and services where they are not cheaper. Second, you try to protect your export market by depreciating your currencies. Third, though inflation rises and currency falls, you will not be able to raise interest rates faster because you are depleting on the growth. And I think these three are the perfect recipe for a bullish gold rally. It might not be visible right now, it will be slowly and gradually be visible. But I think 30-35% rally in the next 2 years is absolutely what we are looking at.
Sure, and that definitely does make sense, Kishore. We will watch out for that. Thank you so much for joining us today with all that analysis and, of course, price outlook. But with that, completely out of time on this edition of Closing Bell. Thank you for watching.